Checking a big board, you know the strip by now, and it's a frightening one. We open higher, we start drifting lower, and we pick up steam to the downside, 16,100. That's going to be your key support point right now. We're about 100 points above that. A lot of names you know still getting hit big time, including Twitter. That stock hit yet another new low. And Wall Street never liked GoPro, and one of the reasons is they think it's a one-trick pony. Well, that trick didn't work too well in December. Sales were weak, and now they're cutting jobs as well, and that stock down lower to a new all-time low. Let's bring in Jeffrey Small with Arbor Financial. I want to talk about oil and the relationship with oil and the overall market. What's going on here?
Well, you know, a lot's going on with the energy market, and I think what they're anticipating actually, Charles, is the fact that Iran's getting ready to enter the market, and that could cause another 500,000 barrels a day that we don't really need, up to that amount.
You know, but the EIA says that there's actually going to be more supply this year than last year. Why is the market reacting to this degree when we know that supply is coming off in America, and whatever Iran puts into the global mix probably comes off somewhere else because it's becoming too expensive to try to drill anymore?
Well, that's true. There are projects being cut back, but production's not slowing. Our production's not slowing, and neither is the Middle Eastern production. That's not slowing either, and it's going to add to the glut, unfortunately.
All right, Jeffrey, I want you to stay there. I want to get back to Jeffrey Small. Jeffrey, despite the fact this market is in turmoil, you've got some stocks you like, beginning with Time Warner.
Yeah, I like Time Warner, you know, and honestly, Charles, we're all looking for diamonds in the rough right now in the market, even though we're off to our worst start ever in the history of this year. I think the market's already down about 7.8%, and that's really the worst start. Probably more volatility coming forward, but I like Time Warner because they really consider them a sitting duck. They have a dual-class shareholder structure, which essentially gives all the control to upper management, and about a year and a half ago, they turned down a buyout for $85 a share when their share price is around 70 today. So I see them as a target, especially for Apple with so much cash.
Although, I don't know. I think if I'm in that space, I go with Disney before Time Warner. But I hear what you're saying. You know, if there's somewhat star value, then it's still there. A stock I like a lot, you like Chevron. Is it just for the dividend, or do you see something else?
Well, I think Chevron is really competitive. They have a very high-quality balance sheet, barely any debt, huge upside when oil prices recover, and of course, like you said, their dividend is doing well.
General Motors been taking market share for over a year, confidently buying back 9 billion instead of 4 billion shares. Forward guidance looks phenomenal, but if the stock doesn't seem to break out, you think it will?
Well, you know, General Motors is leaner and meaner, and they are ready for the prize fight in auto sales. Out of all the automakers, they are the leanest and the most efficient at this point. So if you're going to bet on automakers, that's the one.
All right. Thanks a lot. We love when people come in here and give us those nuggets just like that. We'll see you again real soon.
Thank you, Charles.